Ever wondered what impacts your mortgage rates? Well, it's a bit like baking a cake. There are a few key ingredients that go into the mix. First, let's talk about the Federal Reserve. Now, they don't directly set the mortgage rates, but their actions are like the yeast in our cake mix. They can make things rise or fall. They adjust the federal funds rate, that's the interest rate banks charge each other for overnight loans, in response to inflation, the economy, and employment rates. If the Fed smells inflation cooking, they might hike up the rates, and when they do, mortgage rates often follow suit. On the flip side, if they cut rates, mortgage rates can fall. Now let's take a look at recent events. In the past few years, the Fed has been doing some heavy lifting, raising the federal funds rate to combat inflation. This caused a bit of a stir, with mortgage rates climbing up the ladder. But don't lose hope. Experts are predicting that both inflation and mortgage rates could simmer down in 2024. Inflation is another crucial ingredient in our cake, and it has a significant relationship with mortgage rates. If inflation rises, mortgage rates often go up. If it falls, mortgage rates can dip. According to Danielle Hale, the chief economist at Realtor.com, we can expect mortgage rates to decrease as inflation improves in 2024. Ever heard of the 10-year Treasury Yield? Well, it's kind of like the sugar in our cake. It's a sweet indicator that mortgage companies often base their interest rates on. If the yield goes up, mortgage rates usually follow. So keeping an eye on the trend of the Treasury Yield can give you a hint about where mortgage rates might be heading. Historically, the spread between the 10-year Treasury Yield and the 30-year fixed mortgage rate has been consistent. But recent deviations suggest that mortgage rates might come down, so tracking the direction of the Treasury Yield is key. Lastly, we have the upcoming Fed meeting. Now, this is like waiting for the oven timer to go off. Industry experts are on the edge of their seats, watching for decisions that could impact the economy and mortgage rates. Staying informed and having a team of professionals can help you navigate any changes in mortgage rates and plan your next move. In summary, several factors impact mortgage rates, from the Federal Reserve's actions and inflation to the 10-year Treasury Yield. By understanding these elements and staying informed, you can better navigate the ever-changing landscape of mortgage rates. So the next time you wonder about what impacts your mortgage rates, remember it's a bit like baking a cake. It's all about the right ingredients.